at your net wealth, take a piece of paper. Let's say that you're like me, and you started with a negative number. Here's 0, so you're down here. You're this poor bastard who didn't come from money. You got to pay off your student loans, you got to work until you get a certain amount of money. You start to build some savings. All right, you come out of the box, you're out of 0. Let's say you got 10 bucks. Wow, you grew it to 100 bucks. Monthly, wow, now you got 10,000 bucks. I highly doubt that you buy the S&P 500 with the 10,000 bucks as soon as you get the 10,000. But take your life, let's say that you do this across 30, 40, 50, God willing, 80 years. What does this line look like? Not like that. Where did it go like this? Did you mitigate those drops? Did you or did you not? Because I can tell you one thing, there's a time where you just stay on the line and make no money, but you don't lose it. Forget all this down stuff. I don't do that. I spend every day with this team trying to make sure that your line has as little volatility as possible to the downside and has options to the upside. I can show you, my net wealth is gonna, and I'm not trying to paint myself as some peacock, on CNBC. My line is about as steady and up and to the right as any line you're gonna find after I got to $10,000. With a lot of big jumps. Like in 03, I was up 81%. Why do you think I became a hedge fund manager? 81%. There are moments in time where I will make a lot in something, and there are a lot more times where I'm doing absolutely nothing. Because I like it when my line doesn't have all this stuff in it. It's just something that goes, actually maybe you wouldn't need anything at all. It's just black with a line straight up into the right. Okay? So think about your wealth that way. Don't think about a scheme that can get you rich quick. You don't go up into the right with a tip or with a beautiful Tiffany blue box on owning something forever that has no downside. There is no asset that you probably own that hasn't done that unless you've been long Japanese government bonds for the last 30 years. Okay? So, and treasuries for that matter, they might look close to it. But treasuries from a volatility adjusted return perspective look much more positive, at least in my lifetime, and certainly since we started Hedgeye, than stocks. And particularly if you are global macro and you define stocks as not just US stocks. We're talking about significant declines in significant countries. And again, we didn't have you in those things. And again, I'm not trying to, wax philosophically. I'm just trying to tell you that there's a difference. There's a huge difference in volatility adjusted returns and building your wealth without huge drawdowns.
So the next one, I charted all of the recessions on Fred last night. They overlap pretty well with negative industrial production in virtually all cases. How come the current downdraft in industrial and manufacturing production isn't correlating to a recession? Is it distorted by QE? Are U.S. bureaucrats taking a page out of China's economic statistics book and following suit?
All right, I'm going to do it. I got my new tools.
You want me to hold that?
It's got tape on it.
Oh, look at this.
Is that up there? You can see that?
New props for the show.
See that? All right, we're going to go all fundamental on you here. Math. GDP. Is that big enough? You guys see that? Or is that?
It's hard to see, it looks like.
I think that's kind of hard to see. It's the thing with these companies like ours. These companies are willing to try something and make it fail fast. I hope this works. How's this? GDP. Do you see that better? I think that's better. Okay, GDP. So the question is, how damn it, every other time that we have a recession in durable goods, industrial production, exports, CapEx, how is it that this time we didn't have a recession? Great question. When you calculate GDP, you have this thing called nominal, okay? So nominal GDP is just the number, okay? So think of how much you pay at the pump, okay? So if you buy 10 gallons of gas at the pump, it's going to cost you X amount of dollars. If the price, so that's just whatever nominal is, that's just going to be an X amount of dollars. Now, if those prices inflate, so again, if you go back, you buy the same 10 gallons of gas and the price is up 20%, we have to subtract what we call the deflator, which is basically inflation, to get to what we call real GDP. So, look at that little skinny. I had to draw it small. I was thinking, like, it's kind of small, so I got to make it small. That's how you get to GDP. So if the government would have used the GDP number that we just had in the first quarter, as the deflator, i.e. the real number, and actually many would argue that that's really not the real inflation in the economy, it's wildly understating it, you would have had a recession in Q1, developing. And then you'd be one more quarter away, which could be the third quarter here, where you get a negative GDP number using the right deflator, and you're already in one. And that's really, to me, an important question. Have we already had the recession? Are we, or were we already in the recession? So all these people that are spewing these poppycock things that we never had one, when you're in a recession, you buy stocks. I don't know if you know that, but you buy stocks. When you're in a recession going into a depression, you may not want to buy them real quick. You might want to take your time. But when it's like a depression, you load the boat up. When it's the peak of a cycle, you sell everything. So when it was the peak in the cyclical cycle, which was the end of 2014, if you sold everything, you love us. If you sold everything, everything at every single peak that wasn't a utility, a REIT, or something that looked like a bond, you loved us. This is the kind of thing that really, it's a great question, and it's really kind of sad that the country doesn't know that this is very basic math, I would say. Would you say that that's pretty basic math?
Yeah.
Nominal minus a trivial number that the government has gives you a real GDP number. Shouldn't everyone understand this? I bet you if I quizzed Congress, 10% would pass. I'm not kidding you. That would be an aggressive forecast.
Yeah, or they just don't want to understand it and they have their own agenda.
Moreover, if I gave the test to places like this, anchors, I bet you that it'd be lower than that. The quiz would be, what is the deflator and what would the GDP adjusted for the current deflator have been in the first quarter? You have 10 seconds to answer the question. You can answer if you had
I don't think anyone would know that off the top of their head. The actual numbers. I thought you just meant the concept of real GDP.
Oh, just calculating it?
Or just how do you?
Man, if that's how low we have to go to get to the American intellect, or at least the mass media's perception of their own intellect, that's pretty low. I was actually thinking about the number. Since everybody talks about GDP every day and can only be 0, 1, or 3, and inflation's 0, 1, or 2, I think people should know, if they're in this profession, should probably know what the numbers are. That's just me. That's kind of like a golf. If you're truly trying to profess to be an expert pundit and professional, can you imagine a golfer who couldn't tell you that it was raining? Or couldn't tell you what the wind is? These are pretty basic factors.
Yeah.
Okay? Just saying.
Yep. All right. Next one here. Do you think it's possible the Fed may raise rates to help bank net interest margins and then turn around and go for QE to support the stock market?
Oh, do you want the Fed to do what to net interest margins?
If they maybe they'll raise rates to try to help net interest margins, but I think that's something you can maybe address that assumption that that's going to help net interest margins.
So I don't have a lot of room here. We're gonna have to, maybe this goes like this. Net interest margin. So net interest margin is NIM, the 10-year yield minus the 2-year yield. This morning that equals 79 basis points. Okay? 10-year minus the 2-year yield equals 79 basis points. That, if the Federal Reserve raises rates, the 2-year is going to go up and the 10-year is going to go down. This is going to go even flatter, down. Got it? People say, oh, no. Everything's supposed to go up. When they raise the 2-year, the 10-year should go up too, because the Federal Reserve thinks that the economy is bullish. So the economy should go bullish. Shouldn't it? For God's sakes, think for yourself. If the Federal Reserve raises interest rates, not only does the 2-year go up, but the US dollar goes up, oil goes down.
Yeah, what happened when they did it in December?
Exactly. We call that deflation's dominoes. Deflation's dominoes, okay? When the Fed gets tight into a slowdown, again, increasing the value of dollars, things that are priced in dollars, particularly debts and commodities, go down in price. Okay, that's called the deflation of the reflation. You can't have reflation on down dollar and not get deflation of the deflation of the reflation if the dollar goes up. So if the Federal Reserve were to tighten, which is, by the way, happening across the curve at the low end. If you separate, you shouldn't say across the curve at the low end. I don't even know if that's, I don't care if Wall Street doesn't say it that way. If you take all the low end of the curve, you take 3-month treasuries, 6-month treasuries, all the way up to 2-year treasuries. 6-month treasuries, for example, this morning are up another 4 basis points to 0.45%. They're up about, the 6-month treasury rate is up 25 basis points. So of the 45 basis points that it's at, it's up 25 basis points versus where it was last year. So the short end keeps climbing because Fed keeps saying, I'm going to get tighter, going to get tighter. I can do tighter, I could go tighter, 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 tighter. Oh, we got this regulation thing? Damn it, that's going to tighten it anyway. LIBOR is going up. So they are getting tighter and have been getting tighter into the slowdown. Net interest margins come down, bank profits have come down, bank stocks have come down, bank multiples have come down. The whole thing makes absolute sense. There's no reason why somebody shouldn't be able to articulate this to you. If the Federal Reserve raises interest rates, the short end of the curve goes up, again, net interest margins come down, bank stocks go down, dollar goes up, oil goes down. That's what I think happens. These banks are dead. Like, the whole business model is dead. You know, it's over. I mean, you want to go through like the very basic. It's over. Yeah,
I was going to say your point on the yield curve is the best one to make.
Well, that's on their base business.
Yeah.
If you go to the old wall, like the 3 components of the old wall, you have investment banking, you have sales and trading, and you have asset management. That's the old wall. That's like, behold, the old wall. Like, this is where all the juice is. Forget like net interest margin, like Wells Fargo. Yeah, that's boring. You know, when these guys get into real problems, it's usually all up here, mostly in these two. This old wall is coming down. I mean, this is coming down on itself. This, obviously, to your point, net interest margin looks like a certified train wreck. That's actually perversely what the bankers themselves, who own the Federal Reserve members and the regional presidents, they vote for these. They're unelected people, but they're elected by the banks. Those guys are screwing that part up. This part is the old wall, the actual old wall. Passive is crushing asset management. Sales and trading is a bloody joke right now. It's beyond a commodity business. And then you got banking that's at the end of a banking cycle based on everyone getting money for free. So you wonder why Hedgeye's revenues are up 68% this year? Because we don't do any of this. We're in this other thing that's called research, that you have to have a research view. God forbid if you can tell me it's different this time, that you don't have to have a research view, to have an investment banking view, to have a daily sales and trading view, and to have an asset management view, I'm going to laugh at you out loud. The reality is that research, thinking for yourself, having an independent thought that's accurate, that's why what we're doing has resonated with a lot of people, and it's growing while this is coming down. That old wall is coming down. That's why I call it the old wall. Nobody else calls it the old wall. Why? Because they work for the old wall and or its media. So I was going to show people on volatility.
Yeah.
Okay, so here's a good rule. Actually, we'll start with this one. Okay, let's use the baseline Hedgeye model, okay? 3-factor model, or at least the one that imagine I spell these words wrong. People think that I got enough problems. But so when I give you guys a picture on, I'm giving you a snapshot of style factor models, but the baseline 3-factor model that I make decisions on in terms of timing. Price, volume, volatility. I've said it many, many times. So when I give you a level, it's basically a composite calculation of those 3 things and a reweight change, again, time, a lot of different things that I'm constantly tweaking and changing. So again, the rules though, you can build your own model, or you can listen to me on my model, or do both. That's what I'd really, and again, I got a lot of clients, institutional clients or otherwise, who've done that. So here's a simple rule. If price is going up, I should have used blue.
Or green, yeah, green or something.
if price is going up and volume's going up, and my calculation on implied volatility is going down, that's bullish, okay? That's every single position I like, okay? So, to be consistent with the process, if price is going down and volume is going up and implied volatility in my model is going up, that's a bear. I want to be shorting that security, especially if it's making lower highs. And it's already in a bearish trend. Love those. Yeah, once in a while can you get caught in a counter trend move like I just did in Foot Locker or Tiffany? That happens. But if you're consistent 8 to 10 times out of 10 and you get the trend right, you're going to nail a lot of these shorts. Okay, so that's the bull bear. That's the bull bear framework. Okay, when we can go through a series of obviously there's a lot of different permutations on this, but once we isolate this sucker, which is the thing that really is the differentiator between me and say some, run-of-the-mill technician who's talking about moving averages. I mean, they don't talk at all about volatility because they don't do any math that implies or talks about realized volatility for that matter. So when volatility, you got to think about volatility as a regime of emotion. I think maybe that's one way to put it. And since I'm trying to teach you here on the fly, I've not prepared this, pardon me if I'm not using the right words, but I think that that's a fair thing to do. So when something is in a regime that's bearish, in other words, volatility is trending this way, that's a very bullish thing. When volatility starts to say, I'm done going down, and then starts to not only just turn, but start to go and have a regime change into that's what we call phase transition, then that's one of the top leading indicators within these indicators that something bad on the price front is going to happen. So again, a widening, therefore, if you have something that was bearish volatility and it starts to go from over here, what's the range doing? It's widening out. A widening risk range is therefore bearish prospectively, all things which you can't really hold anything equal. But if I'm a probability batter, and that's what I am, if I see that developing, I don't like that. If I'm long it, that's what I saw in McDonald's, for example. I'm like, I'm out. As soon as I see that, I'm out. And sometimes I'm wrong, but a lot of times I'm right on that. And I go with what I get a lot, not a few. So you go with your best stuff. I'm good at hitting batting cage pitches because they come right down the middle. I'm not good at hitting a Major League Baseball pitcher's pitches because I can't hit a ball. So again, understand your parameters. Equally relevant, when this thing's wide and starts to narrow, so in other words, if you have a bullish trend in volatility, and then all of a sudden it starts to go this way, and the range starts to go down and get narrow, that's very bullish. Yeah. Anybody, monkey, there's been plenty of research on, I don't know why people are so offended when you get called a monkey. A lot of monkeys have beaten a lot of portfolio managers over the years. These monkeys should deserve accolades. But a certified monkey can buy anything that ticks. It can be gold, bonds, obviously equities. If the range is tightening, you can be long it, and as long as it never widens again, you can be long it forever. That's Japanese government bonds.
Rewinding to your Q2 2016 recession call from the fall in 2015, where are you on that now, or what has changed? What has become more or less probable at this point?
Yeah, I appreciate how you asked the question. I think that's right. I think our audience is getting a lot sharper, by the way. I have to get a lot sharper. As my Nana, God bless her soul, who passed away a while ago, used to say, Keith, even when you're having a bad game, you got to look sharp, man. It's important to not look like you're just losing it, okay? So don't lose it. Don't lose yourself in the old walls narrative. Just get back to where you were, which is trying to get ahead of the probability of something happening, rising, while consensus doesn't yet or hasn't yet positioned for it. So one simple way to think about that is if you have GDP and you have basically a sine curve. So GDP in the U.S. looks like this. And the top end of GDP in this economy, fully loaded with all the secular issues, demographics, and deflation risks, that's as good as it gets. That was as good as it got, okay? And I'm talking year-over-year rate of change, not like sequential hiccups and head fakes. That was as good as it gets. So our call in a recession, and your call should always be, that after GDP puts in its peak and starts to roll over to 2, to 1, oh, 0's over here, that the probability is rising as this line is going down. When we make the call, when we made that call in the, at the beginning of the year, that's what we said about the first quarter. That'll be one of the worst numbers that you're going to see. If they actually used the right deflator, it would have been a negative GDP number. And obviously the second quarter number was right here, 1.1. Okay, so this is the growth slowing call. This is the long bond call. From here, you either get nothingness, or maybe, God forbid, you do get a recession, or are you going to go right back up like that? You tell me. The comparisons are at the toughest level that they've been at for 70% of the number in 9 years. Where am I going to go with the call? Am I going to go with this call? Or am I going to say, oh, stocks are up. I got to go. I got to say, feels like 3% GDP again. No, that's ridiculous. That's why we call it the old wall, and that's why they don't like us, because we're calling them out for very obvious reasons.
Yeah, and I mean, your point on tough compares for 70% of the number, ultimately, like, can some PCE, that you're referring to PCE comps, and I just...
Yeah.
It's
the only way you can get to going from 3% peak GDP growth, it's not the 90s, it's not 4 to 5, okay? Newsflash. Slide, I don't know, Josephine, 92, I'm just guessing, in the deck and the appendix on demographics. So this, don't forget, see the 1990s when the main spending cohort of the US population, they're called the baby boomers, were growing at their fastest rate, spending their brains out, buying 2 and 3 homes? That's called 3 to 4 to 5 to 6% GDP growth, okay? See the red stuff? That's when all that population went negative in terms of their rate of change in growth, okay? So that's why, you can take that off. One of the most important charts that we've shown people since we started the firm, by the way. That's why it's not 3 and 5 and 10% GDP growth. It's a straight line down. You can see this going back to World War II, that we have not achieved that level. Every single economic cycle goes to a lower high. And I'm giving a lot of credit to a 3% number being the best of the scenarios, okay? So it's not 3, it went below 2 and started heading towards 0. They basically started to fudge the deflator number. Then they finally reported the right deflator number, so you're now at 1. That's what you have, okay? So that's where we're at. I don't know if there's any other reasonable or probable scenario to go with as the toughest comparison. And the only way, I guess is the point I was trying to get to all along, the only way to get to 0% and lower, like a recession, a 2 quarters, how they define a recession is 2 quarters in a row of below 0%. So this is negative here. From here on, these are negative GDP numbers, -1, -2. To get that, you have to have the 70% of the number, which is the consumer, go negative. That's not happening. That's why there's no, I call it American Goldilocks. GDP is, as long as it's greater than 1, but it's less than 2, you just kind of hang out in here and you chop everyone up trying to argue about why you're there and everything that they missed. Been there, done that. We didn't miss the big moves, by the way. Somebody would say, oh, but you missed nailing the S&P 500 off the low. Yep.
All right, moving on.
That has nothing to do with my economic view. And by the way, do you know any other strategist who has to make real-time market calls with levels that also has an economic view and model that's more accurate than most people's? No, I mean this is who I am and what I do. If you don't like it, don't watch.
What would have to happen for growth to reaccelerate and be sustainable from here?
Well, you'd have to call there's this damnedest saying, it's called the cycle. So what happens is that you have to get the sine curve to start to go up again. The data would lead that, the consumption data in particular. So again, I'll start doodling on a piece of paper here in a second for you. You'd have to have actual economic data accelerate in rate of change terms, which clearly is not happening, before you say, oh, but the consumer, oh, but Amazon. That's hanging in at the 9-year high. Actually, I better go to the wood. Or did you guys want me to go? I think we have another one now. We're going to have multiple camera shots on this. Thanks for the feedback, by the way. People say that this is a reasonably good idea to show you what's going on. So if you have a sine curve, this is your life in market terms. GDP, inflation. GDP peaked right here, plus 3%. That's the top end of the sine curve. Growth started to slow down towards, some people thought, and I thought, if they actually used the right deflator, you could have got to 0%. This is 0%, 0% GDP. So if you're beyond that, you're in a recession. You're slowing. The question is, what makes you go up again? White space, no data. Consumption, which operates on a lag to total GDP because it's late cycle, it's kind of got it looks like that. Okay? So what you want to do, if you're a permabull, and this has been 9 years, okay, that the rate of change has been bullish in consumption, you want to hang out for as long as you can up there and pretend, because in my career, the last 17 years, this line, this green line, when it comes down like Merrill Lynch's thundering turd. It comes down hard, okay? That's consumption. I mean, if you're actually an industrial company, your line has gone basically through the zero. You're in a recession. Okay, so let's be clear about this. This is when you're asking about the economy, that's what the economy is doing. So as a bearer, or as a uber bull, I should say, of the long bond, I mean, I'm trying to recast myself as Lehman's next broker, reform broker. I will be if you're an uber bull, like if you want to come to work every day saying, I'm bullish, you got to buy. Those better be bonds. If this green line comes down and starts to come down fast, you better be buying everything that looks like a bond, smells like a bond, stands like a bond, because it's going to be hard to lock those down as the Fed has to go back to dovish.